Good morning from London. I'm Anna Edwards alongside Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Standard Chartered plans to hand back $1.5 billion to shareholders after the lender's trading and wealth businesses helped propel it to an earnings beat. The Bank of Japan's governor signals he may intervene in the bond market to ease surging yields as accelerating inflation raises rate hike expectations. Plus, will undecided voters in Germany dent the lead of Conservative Friedrich Merz? We'll have full coverage and analysis of this weekend's election throughout the show.
Well, happy Friday, everyone. Checking in on these markets, and we have Asian markets powering ahead after the Alibaba earnings, optimism about China tech, and not quite that spilling into European futures yet. We've got all the wariness around the geopolitics, tariffs as well, but futures pointing a touch higher on the Euro Stoxx 50 futures. The Treasury yield on the 10-year at 4.48% after our interview with the US Treasury Secretary Scott Bessent. We're going to dive into that. And the yen at 150 per dollar. It had climbed on the expectation of Bank of Japan hikes. Then we had that beat on Japanese CPI, and then we had Governor Ueda saying that he is still ready to intervene in these markets. So weakening a touch, but the countdown to the opening trade starts right now.
Welcome to the programme, everybody. Welcome to the opening trade. It is Friday, check date, 21st of February. Welcome to the programme. We have a lot to deal with. The German political story will play out over the weekend, and no doubt coalition forming in the weeks ahead. The Ukraine story, of course, will play out in the weeks and months ahead. But let's, for the moment then, Lizzy, get to some of the corporate reporting that we've had this week and this morning. At Standard Chartered, the London-listed, but Asia-focused bank, as we're obliged to say, they have, well, Asia and Middle East increasingly, they've reported numbers this morning, and the numbers themselves coming in better than estimates, a buyback in the offing as well. It really interesting the way that this business is shaped and structured, because they are decreasingly reliant, as lots of banks will tell you, on net interest margin and therefore what interest rates do to dictate what profits they make. They're increasingly relying on fees, which is something that other banks are doing. But this is a bank that's 50% only reliant on net interest margin, and fees is the rest. So that's an interesting part of the conversation, and it's those fee areas that they have confidence can continue growing. So, for example, global markets and the wealth management side.
Yeah, and a lot of this restructuring happening on the watch, of course, of CEO Bill Winters, who is now the longest-serving CEO of a major UK bank-based bank, I should say, as you point out, a lot of their business in Asia. But interesting that during this reporting period, you saw that turnaround in the share price. Remember, he once described it as crap.
Yes, I said that word for the first time on air, I think, in the last hour of programming, in my interview with the CFO.
Yeah, well, I mean, he must have been pleased off the back of these results. Bill told me that it was less crap than it was, but, you know, he still wanted to see improvement. But, yeah, you are seeing the turnaround here largely because of this restructuring that's happened on his watch. And, yeah, a fresh buyback, $1.5 billion.
Yes, and a really interesting view they have on what's going on in a sort of deglobalisation narrative, because that dominates a lot of our thinking, doesn't it? And thinking about whether there are alternatives to the dollar and US-denominated assets and the like. And interestingly, he's talking about, yes, a deglobalised world, but actually just more business, more growth in slightly narrower corridors. And that's the way that Standard Chartered is looking at some of this. Shall we move on to the Japanese story? Because this is really interesting, the way that Ueda is pushing back against hike expectations.
Yeah, I mean, so we had this latest eco data out of Japan, the CPI, the highest since early 2023. So driven by food prices, you've had hot summers, you've got the weak yen, this labour shortage as well, all of which keeping the BOJ on track for more hikes. I think just on this, before we get to the kind of yield story, interesting that you've got this dichotomy, this irony of Ueda saying, you know, it's not quite where we need it to be, inflation, but then that cost of living crisis being a political headache when it comes to Prime Minister Ishiba. And one report saying that, you know, the big food companies are looking to double the number of products that they're going to raise prices on next year. So for voters in Japan, that's not what they want to hear.
Yeah, that core inflation number certainly looking much, you know, 3.2%. And this is one of the few parts of the developed market world that we're talking about rate hikes, of course. And there is then this market expectation, I think, an 84% chance that we get another hike from them. Not until July. feels like a long time away. It's only February, Lizzie. A lot can change by July.
Indeed it can. But yeah, so we had this strength in the yen yesterday, and then yields falling because Ueda said that he is ready to intervene in the bond market to contain the surge in yields, and that knocking the yen. So we're still floating around a 150 handle, but weakness today.
OK, let's stick with bond markets and talk about what's happening with the Treasury markets, because we had an interesting conversation, the surveillance team yesterday, talking to Scott Bessent, the Treasury Secretary. And Bessent, really interesting on a number of subjects. We'll talk about long-term debt and we'll talk about Ukraine in just a moment. But long-term debt, really interesting. They're saying, you know, the time is not now when it comes to reshaping what they're doing. Terming out is the term there. So they're sticking to the path, the structure of the debt market. It would seem that Yellen put in place, even though Bessent was very vocal in criticising that.
Exactly.
But that takes us on to an interesting conversation, because there's increasing chatter, and no real news, we should be clear, but increasing chatter about whether we get some kind of Plaza Accord 2.0, a Mar-a-Lago Accord, perhaps. And that would involve devaluing the dollar, perhaps. But perhaps it would also involve encouraging / forcing investors in treasuries to move from shorter dated to longer dated debt. And so that's another part of this radical approach, I suppose, that we're watching, or just at least something we need to be mindful of when we're thinking about just how radical the Trump administration might be on financial markets.
Yeah, the reason we know that this chatter is happening is because Jim Bianco got on the phone and was telling clients about it. And to be clear, it's not something that, you know, is seen happening imminently, but if it's going to happen in the Trump administration, it's going to happen within the next 4 years, and it would upend global financial markets. So really want to watch, you know, just as you say, weakening the dollar, lowering interest rates, bringing down the debt burden, a massive rumour if it's true.
Yes, I'm also fascinated by the role that Scott Bessent is playing in peace in Ukraine, because it does seem as if we have a president in the White House who is trying to bring about peace in Ukraine through a business deal. It seems as if he's going after the mineral wealth of Ukraine. That is something that seems to be a top priority. Vladimir Zelenskiy has been linking that and saying, well, hang on, I don't want to sign it if it doesn't include any security guarantees. Scott Bessent saying that America being in there, America having an economic interest in Ukraine is like a security guarantee. This is a whole different way of talking about global diplomacy.
Yeah, and of course the war in Ukraine, a huge factor when it comes to the German election, which of course we'll have full coverage of right here.
Yeah, exactly. Let's do that now, shall we? Today's German PMI data comes just 2 days ahead of Sunday's German election. Bloomberg's Oliver Crook joins us now from the Chancellery in Berlin, can take us through some of the expectations. So set us up then, Ollie, for what we should expect as Europe's biggest economy, the Eurozone's biggest economy, heads to the polls.
Yeah, and I mean, it feels like we've been on the election trail for quite some time because, you know, this sort of government collapse back on November 5th, which was in fact also the day that Donald Trump was elected president of the United States, really turned out to be quite a fateful day for the future of Europe and indeed the future of Germany. And this has been a sort of very protracted process. And what's been very interesting and what we've noted throughout this election campaign is that when you look at the polls, not a whole lot has changed since November. You still have the CDU leading with about a 30% anticipated. What has been one of the great features of this election campaign, in distinction to the many of the last few decades, has been the fact that the AfD, the Alternative for Deutschland, is the #2 party in the polls right now and has really been a protagonist. This has really been sort of the marching, the beat to which all of these other parties have been forced to sort of adapt their politics to the sort of new politics of the far right in Germany. When we head into this weekend, we look at those polls. It's important to also look back at kind of what past sort of parties have led, with what proportion they've led in the parliament. We're expecting the CDU to have 30%. That is getting a little bit closer to the figures we were getting from Merkel, but she tended to get much higher numbers in order to lead a government with a much larger majority. We should say Olaf Scholz only had 25%, which was a sort of part of the reason that this coalition was so weak going into it. But on Sunday, we'll get the exit polls starting at 6 p.m., and by 7 p.m. on Sunday, we should have a very good idea of the composition of the next parliament here in Germany.
Yeah, interesting to see pollsters getting nervous about an election surprise, Ollie. Not the sort of thing we usually get when it comes to German elections, but no party expected to win an absolute majority here. So what coalitions could we potentially see? How long could it take to actually form those coalitions?
Yeah, Lizzy, that'll be down to a number of different sort of factors. I think that one of the interesting features of the German election is that, yes, obviously it's important who gets the most votes. It's also important who gets the least votes, because any party that gets below the 5% threshold actually gets ejected and booted out of the Bundestag, and that means you only need to form a majority of what's left. That really sort of rewrites the whole arithmetic of how you could form a government. So the sort of base case right now, and I think the best case for markets, would be a CDU-SPD coalition. This is basically an arrangement we've seen very perennially within the German sort of political structure over the last few decades. That's the SPD and the CDU coming together. We should say that if the SPD does do as poorly as it is anticipated to, its worst showing in history will probably mean that Olaf Scholz will step out of the picture, meaning it'll be easier to build a government. But you could also have a scenario where the CDU works with the Green Party. I've spoken to senior CDU lawmakers who have said that despite the fact that they seem sort of politically a bit closer to the SPD, that actually on an interpersonal level they get along a lot better potentially with the Green Party. So all of these are sort of to play for, but we should keep in mind the point that you just made, Lizzy, and a point that Olaf Scholz made really this week. There are a lot of undecided voters. I mean, you see this in the polls, but you also see this anecdotally when you speak to people here. There are a lot of people who don't really know who they're going to vote for coming into on Sunday, and if those sort of votes get sort of taken away from the CDU and dispersed across the political spectrum a little bit more evenly, you could have another situation where you have a very sort of fractured political situation, and again, the recipe for yet another term of paralysis here in the German parliament.
Don't know or won't say. I'm looking forward to talking more about the polling later in the programme. But Ollie Crook in Berlin, we thank you. We'll come back to you later on. Today, we are going to get more of a steer on how Germany's economy is faring, which, of course, is such a key issue in this election. We're going to get initial PMI readings for February. So after the markets open, first we'll break you France and Germany's PMIs, then look out for the euro area and UK prints on the pulse after 9 a.m. And then across the pond, the US data breaks at 2:45 p.m. UK time. And a very different picture on the two sides of the pond when it comes to the economic story, what the ECB and the BOE are dealing with when it comes to weak growth compared to the strong growth of the US.
Yes, exactly. And we wonder if we get any signs. Dare we say green shoots? We were talking about green shoots about China yesterday, weren't we? Do we dare say that about European manufacturing? I mean, some of it ticking back upwards in the last most recent PMI data. We'll see if we get some more of that today. Let's tell you what else is coming up on the programme then today. We'll be talking to Sebastian Bazin, Accor's CEO. We will also be joined by Nicola Mai, PIMCO Portfolio Manager, Sovereign Credit. Kieran Nandra, Jupiter Asset Management, joins us, Head of Equities, to talk about European outperformance year to date. Is that over? Also, we look ahead to the German elections. We'll have plenty of analysis on that front. We'll be joined by Eric Langenbacher, who's a Georgetown University professor on German politics. He's in Berlin for us. Also in Berlin, John Kampfner, the author of In Search of Berlin, and one time full of praise about the German model. It's changed a lot, of course, Lizzy, so we'll be getting his thoughts.
Lots of exciting conversations coming up. Here's what else you need to know, though, this morning. Citigroup is scrapping workplace representation goals and removing requirements to interview job candidates from diverse backgrounds. This is citing pressure from the Trump administration. The shift follows a long list of US companies that have already cut back on diversity initiatives in the wake of these political and legal pressures. Elsewhere, shares of Nissan surged on a report that high-level Japanese group has drawn up plans for Elon Musk's Tesla to invest in the struggling car maker. The Financial Times reporting that the EV maker is interested in acquiring Nissan's plants in the US. Nissan finds itself in need of a lifeline once again, of course, after a deal with Honda failed earlier this month. And Alibaba shares surging, leading Asian tech stocks higher on stronger than expected revenue gains in the company's e-commerce and cloud services divisions. The CEO, Eddie Wu, announced plans to spend more on AI infrastructure over the next 3 years, a sign that the Chinese internet pioneer, co-founded by Jack Ma, is taking another step towards recovery. This is really interesting, Anna, because as you say, we've had a lot of conversations about green shoots when it comes more broadly to China, and perhaps more when you're looking at property and the miners. It was Duncan Van Blad of Anglo American who said that, but echoing really BHP CEO Mike Henry. But we've had this repeated scepticism from our analyst, Rob Lee, over on Bloomberg Intelligence, about the hype around China tech. And he'd said it before the Alibaba earnings, and I had a little look to see if he was holding with it after their earnings. And indeed he is. You know, he says that they are piling into AI over at Alibaba, and for him, and I'm quoting, it's a massive speculative gamble. And achieving this holy grail of AGI, the ability to mimic human levels of intelligence, is going to take a significant tech breakthrough. It's not clear where the current generation of models can achieve it, with any payback unclear and indistinct.
That's interesting. Yeah, that's interesting, because I think he's been quite positive on the ability of China tech, DeepSeek, for example, to catch up with the Americans, or to do a good job of trying to do that at least. But maybe on AGI, you know, that is a step too far for some. That's pretty ambitious. But yeah, we do have the CEO of Alibaba talking about that. The pursuit of artificial general intelligence is now our primary objective. That is how important it has become to Chinese tech, to Alibaba specifically, but to Chinese tech more broadly. And interesting to see, as you say, this is putting a fire under the Chinese tech stocks today, up the most in 3 years, a sixth week of gains for Asia stocks, unlike European stocks, which have kind of wobbled this week after a good start to the year. So perhaps we're about to diverge in terms of our European and Asian fortunes. Coming up on the programme, we will head to Cape Town, where G20 meetings are taking place, and South Africa tries to cool down tensions with the Trump administration. Plus, we will check on shares in Air Liquide, as this at the open, of course, after the French industrial group reported a net profit miss. We'll also be talking, we're having a conversation next with at the Accor CEO. Accor shares closed lower on Thursday after missing on one of the key revenue per room estimates. What's the wider conversation around the hotel business right now? Interesting take on some of the global trends we talk about regularly on this programme. CEO Bessent from Accor joins us shortly. If you want to get involved in any of these conversations, IB plus BBTV Go. That's the function to use on your Bloomberg terminal. Happy Friday, everybody. This is Bloomberg.
This Sunday, Germany heads to the polls following the collapse of Chancellor Scholz's coalition. With the focus on the economy, migration, and geopolitical tensions, how will the German balance of power shift? Bloomberg Television has continuing coverage leading up to the election and will bring you the results after the votes are tallied with a special post-election broadcast. Tune in Sunday, starting at 5 p.m. London time. Only on Bloomberg. Context changes everything.
Welcome back to the opening trade, and Accor shares have slipped in Paris trading after the hospitality giant's full-year earnings. Some analysts highlighted weaker revenue per room growth. Others pointed to better performance on free cash flow and net debt. Well, we can dive into these results now with the Accor CEO, Bessent, who joins us round the table. Welcome.
Welcome. How are you?
Good. Nice to have you. Thank you. I want to start with my favourite part of the business, the luxury and lifestyle division. Do you want to tell us what trends are growing there, what you're seeing in the past and looking forward?
What we see is double revenue pace compared to premium economy and mid-scale. So it is much faster, much riskier, much more difficult to execute because it is much more experience-driven. So for the high net worth individuals, they accept to pay the price if they have an impeccable service and a great experience. So it is a place where you can actually navigate through better waters because you have actually a higher spending level from the guest. So it's a fascinating place, but you'd better be right on the brand incarnation, brand promise, brand marketing product. So you can't miss. But if you don't miss, you have much better results.
OK, so you have some more pricing power as long as you get the product right.
That's correct.
In that area. Let's talk about the broader experience on revenue per available room then, Bessent, because that did seem to be some area of a bit of disappointment yesterday in the numbers. Anything that the market needs to understand?
I was not disappointed.
You were not? Well, that's excellent.
Our numbers yesterday were very good. So market slipped 3.5%, but it went up 40% the last 12 months. So I guess he can slip one day as long as it doesn't slip for the next 10 days.
OK, so you weren't disappointed, but anything that we need to understand?
No, I was upset, but I was not disappointed.
Something that the analysts have been a bit more positive about, though, is around your growth up to this point and saying, the post-COVID recovery has played out really well for you, but you still have these quite tough targets that you want to meet. I think 9 to 12% EBITDA growth, that's your target for 2023 to 2027. I mean, we're not in are we still in a post-COVID world? Can you still make those kind of growth targets come through?
I'd better, because actually this is a commitment I've made. Like a year and a half ago, I said I'm going to be up 9 to 12% for 5 years in a row, from 23, 24, 25, 26, 27. So, yes, you can still make it if you end up in the right geographies. Like, for example, you're going to be going at a probably 12 to 15% pace if you're in the Middle East or in Asia Pacific. It's going to be slower in Europe. It's going to be pretty good in South America. It's going to be middle ground in America. So it's as long as you basically get fast to those growing economies, you're going to be just fine.
So it's about providing a lot of new hotel space in some of those geographies.
It's providing new hotel space. It's actually lowering your costs. It's getting better on distribution. It's using better AI. It's having a better loyalty system. It's basically accumulation of many good things and having the right talents. But no, we're going to deliver on it.
And you're confident about the construction environment in the regions that you're talking about?
I am confident in construction, but what I'm the most confident in, they have the financial ability to invest. There's only 3 places in the world where they have vast amount of money for hospitality: America Inc., Singapore Inc., Middle East Inc. This is where you want to be.
You mentioned the labour issue, getting the staff, and when it comes to US Inc., do you think that Donald Trump's policies are going to make it harder for you to get those workers or impact the business more broadly?
Well, it could. Accor has only a 5% exposure to US, but 12% of my EBITDA, so pretty significant in terms of contribution. Labor is back in all the different hotels of Accor, including in America. It could have an impact on all the immigration in America, but I guess invite Marriott CEO and Hilton CEO, they're probably going to know much better when it comes to America. But labor is no longer an issue for us. What is the issue for us is training. I mean, people don't know. Accor is hiring every year 120,000 new people out of 350,000. 2/3 of those people we hire in Sub-Saharan Africa, in South America, in Asia Pacific, never had a job before, never went to university. And we welcome them every single year. We train them to teach them a job, and they are very, very good. So it's just a question of actually apprentices and welcoming people.
Just in terms of the international portfolio, though, Donald Trump's pushing for a rapid end to the war in Ukraine. Would you start investing again in Russia if that happens?
Could you give me the benefit of time just before everything settles down? Russia was a very big market for us. We were a leader in Russia.
Yeah, that's why I ask you. I mean,
our hotels still exist in Russia, but I guess we don't have any distribution system. They're not open. So the minute the war has ended, and if my board of directors is comfortable, if all the sanctions are being lifted from the Europeans, because I'm a European national, and so I'm going to follow the rules of the Europeans. And so with time, it's going to come back, but, it's not for me to actually to assess.
We're heading towards a German election as well, Sebastian, and wondering what doing business in Germany is like at this point. The state of the German economy, the challenges it faces, gets a lot of press. Is that showing up for you, for businesses like yours? No,
what's interesting about Germany? Germany has been a horrible year in 2023. Far less than, I guess, what we had in Northern Europe, in France and UK. Surprisingly enough, in 2024, they caught up. We had a better year in Germany the last 12 months than we had in France and in UK. So when it comes to the election, that's going to be only 4 days from today. Well, I've never predicted the French election. It's been horrible. Don't ask me to predict the German election.
I won't put you in that position. We talked about the migration story in the US and whether that's going to inhibit your ability to hire staff. Is this an increasingly worrying theme in terms of staff availability? Is this difficult for the hotel sector in Europe as well?
Not really. In Europe, we basically found back everybody who wanted to come to job. Immigration. Seriously, on my top 10 priority list, immigration is not part of it. We found local laborers basically where it stands. Certainly when it comes to Saudi Arabia, we have a lot of people working in the Accor hotels, non-Saudi nationals. But we've made a commitment to have 40% of the staff being Saudi in the next few months. So we have a lot of people coming from India, from Pakistan, and other places. But I never had to deal for the last 12 years with immigration authorities to basically ask for a greater pace. Never had to.
Okay, Sebastian, we'll see if that remains the case. Sebastian Bessent, the CEO of Accor. We thank you very much for joining us this Friday morning. Coming up, the countdown to the German election, of course, is on. Can the snap vote called by Olaf Scholz deliver the stability Germany and Europe needs? We will discuss that next. This is Bloomberg. Welcome back to the programme, everybody. This is the opening trade. It is Friday morning, and this is the futures picture. We had quite a lot of weakness in US stocks yesterday. Doesn't look as if that will translate directly into losses here in Europe. European equity markets trying to eke out gains for the week, but struggling to do so. Euro Stoxx 50 futures up by 0.2% this morning. Let's have a look at the bond markets, because here our focus is going to linger because, of course, we have a German election coming up, and we have a lot of data out today, PMI data, our first glimpse of another month's worth of manufacturing and services data. We don't see much movement, do we, in the bond markets this morning? Just a touch. We see a little bit of buying and those yields going down just a touch. Let us talk to Nicola Mai, who leads sovereign credit research in Europe for PIMCO and is with us this morning. Nicola, very nice to speak to you. Thank you for coming in. It is German election minus 2 days, and so that is front and centre in our minds. We've got a 10-year yield in Germany, 2.529. What is at stake for German debt, do you think, in this election? What are you watching for?
Look, I think people got a bit overexcited about potential changes in fiscal policy in Germany on the back of this election. You know, I think a new government will probably or will try to change the fiscal rules, the constitutional debt brake, the straitjacket that Germany has in terms of keeping a balanced budget. But we think that changes will probably be marginal. I mean, let's not forget that the CDU is a very fiscally hawkish party, ultimately. And also the changes are not guaranteed, because if you have smaller parties reaching a blocking minority of 1/3 of the parliament, you may not even be able to change that rule. So actually, the rise in yields, the steepening of the curve that we've seen, the rise in yields that we've seen on the back of the fiscal election is potentially excessive relative to what's going to happen.
OK, so do you think that a CDU victory, I mean, is priced into bond markets? Is that what bond markets expect? So if we get the CDU as the biggest party, there shouldn't be too much movement? Or do you think it will very much depend on who the coalition partners are, just SPD and Greens, or some other combination?
I think it would be a very big surprise if the CDU didn't win the election and did not form a government in a coalition, either with the SPD or the Greens or both. I think what could be the element of surprise is if the small parties reach, go above the 1/3 blocking minority that would not make the constitutional debt brake change possible. In that case, there could be a pretty meaningful performance of bunds, because then the expectations on fiscal easing would go down. OK,
that's really interesting. So actually, it's to do so the performance of the bond market has a lot riding on who are the smaller parties and how well they do, rather than necessarily who wins here.
Well, yeah, I kind of wonder whether the bond market is going to be more driven by German politics and all the wrangling to make a coalition, if there needs to be that wrangling, and what happens on government spending, or ECB cuts, Nicola.
Yeah, I think macro ultimately dominates here. I think what's going to happen to inflation, to growth, is going to be key. And I think, the market is pricing the ECB cutting to 2%. If anything, I would take the under on that one, given the big increases in trade uncertainty that we've seen globally, given the Trump policies. I think Europe is very vulnerable here. So.
But that's interesting, because you have the likes of Isabel Schnabel saying that the ECB is going to be, talking about pausing or stopping rate cuts soon, and yet you think that there are going to be more cuts than the market's pricing.
Well, I think that we must keep in mind that Schnabel is clearly in the hawkish contingent of the council. As you know, there is a spectrum of views. I think the center of the spectrum is an ECB that thinks that neutral rates are around 2%. Lagarde and their study says between 1.75 and 2.25. I don't have a massive disagreement with that, but there is a lot of downside risk to European growth given the ongoing trade war or the trade environment, which is pretty adverse.
And you think the sluggish growth picture around Europe, you think that is positive for fixed income, because maybe investors want to sort of find some perceived safety, at least, in fixed income. So where in the curve do you want to be? Not at the longer end, I think, but more the middle of the curve.
I think that is right. We like the intermediate part of the curve, the 5-year, the 5 to 10-year part of the curve, the belly. I think you don't want to be in the very front end, because cash yields are going down. The ECB is cutting rates. You don't want to be in the very long end, given higher global issuance and quantitative tightening by central banks. So we think the sweet spot is around the 5-year.
And if we see more defence spending in Europe, where does that hit along the curve?
Defence spending, I would say, would tend to steepen the curve on the expectation of higher issuance, which tends to raise the long end of the curve. So again, I would think that the intermediate part is probably the better part of the curve.
You mentioned all the uncertainty around tariffs, but we've had the EU Trade Commissioner saying that the EU is actually willing to talk about cutting tariffs. Maybe I'm going to paint a best case scenario. What if actually the bark of Donald Trump was worse than his bite and the retaliation isn't as bad as we expect? Could we actually see all of these trade threats becoming beneficial and we see more free trade and that being good for markets?
Look, potentially there's a lot of uncertainty, so we need to recognize that. My view would be that the uncertainty itself has gone up. That we know for sure. The destination we do not know exactly, but for some time corporates are not going to know what the trade environment is, and we have seen in 2018-19 that when trade uncertainty shoots up, investments get curtailed and growth weakens, and I think Europe is vulnerable in that regard.
We've mentioned the defence, the impulse to maybe issue more debt to fund defence spending. Nicola, a lot of people talking about the possibility of joint debt issuance. We've seen some of it. That sort of taboo has been broken, but not on a very large scale. And the Germans perhaps would rather still keep a close lid on that. How do you think that's going to play out?
I think the solution is going to be a combination of easing the fiscal rules to some extent, maybe initially through an escape clause, which is a temporary exception to the rules, potentially over time moving them more permanently. But also I think there's going to be over time some increased EU issuance on the back of it. Exactly what form that will take, we will see. To create a sort of NGEU2, like a proper new program, takes time because you need all the parliaments to ratify it and so on. But I think you will have a combination of more EU issuance and national issuance. Now, one point I would make is I would not exaggerate the macro impacts on the European economy, partly because a decent amount of defense spending is important, and so the multipliers on growth are not going to be that high.
Just finally, on the defence spending point, we have a lot of pressure on the UK to spend more on defence. We've just had a story saying, Britain is set to overshoot the borrowing forecasts after a poor January. We're heading towards this March spending review. How are you thinking about gilts at the moment? Are you any more confident?
We like gilts. Look, I mean, if you look at the curve, the UK curve is basically on top of the Fed in terms of market pricing, central bank pricing, for an economy that has been a lot weaker, where most likely neutral rates are lower. And we think the government will ultimately consolidate fiscal policy. There may be pressure to increase defense spending, but on balance, we see fiscal tightening, and that should allow the central banks to ease, and we expect more easing than what's priced in the market. So we like gilts.
Let's see if those spending cuts come after March. Nicola Mai, sovereign credit analyst over at PIMCO. Lovely to have you with us. Thank you. Well, let's get to Berlin now, where we're joined by Eric Langenbacher, a teaching professor at Georgetown University and author of a book called Shifting Paradigms in Contemporary German Politics and Policy, which very much sums up what's happening right now, it would seem, in Germany. Really good to talk to you, Eric. Good morning. Thank you.
Thank you for having me.
So I'm an outsider to German politics, and I'm really fascinated by the polls. In the UK, we have this phenomenon of shy Tories, where people say that they're going to vote left or that they don't know how they're going to vote, and then they end up voting right. So the polls end up being inaccurate. But I was told that in German polling, actually, people are very honest. Historically, German polls are very accurate. Do you think that's going to be the case this time? Do you think that the AfD is going to do as well as some polls are suggesting?
Well, that's an excellent question. The polls in Germany have been a little bit more accurate than in other countries, but there are some examples of shy AfD voters in the past. But I was just talking to some pollsters yesterday and the day before, and they're very aware of that kind of issue, and they've tried to compensate for it. So I think the polls are probably about right. What's interesting, though, is even though the rank ordering of the parties has been the same for a while and there's been very little movement one way or the other, I just saw a poll that came out this morning, a couple of hours ago, that saw a little bit of movement with the AfD up a point to around 21%, and the CDU-CSU, so the main kind of conservative party, down to 28%, which is about 2% lower than they've been polling the last while. So we might see some last-minute movement. It's also true that there's about 10% of the German population that's still undecided. And in the last couple of elections, between 8 and 10% of people have decided on election day. So there could be a few surprises. That being said, I don't think the AfD is going to do any better than 22, maybe 23%, which is where they were polling 4 or 6 months ago. But I don't think they're going to do any better than that. But yeah, they're gonna definitely be more than a fifth of the German electorate.
Go on, what is the one election surprise that no one is seeing coming?
Well, that has to be the Left Party. The Left Party, which is pretty far left on a lot of different issues, was taken for dead 6 months ago, 9 months ago. One of their most prominent leaders, Sarah Wagenknecht, left the party, started her own party called the Alliance Sarah Wagenknecht, and they seemed defunct. They were polling at 3-4%. And of course, in Germany, you need to have 5% of the vote to be eligible for seats. But now, I mean, I saw a poll the other day that had them at 9%, but certainly they're over 5%. They're at 6-7%. And that is really something that has surprised a lot of people. It has a lot to do with some very dynamic leaders within the party. Their social media presence has also been very, very, very effective. But that is really the big kind of surprise.
Yes. Yeah, and that could be important because some of those smaller parties could come together to create a blocking minority on certain policy issues. Eric, good morning. Nice to have you with us. Let me ask you about the firewall that traditionally exists in German politics to keep the AfD out of government. You think that is being eroded, but you don't think it goes this time around. Is it inevitable in some way that the AfD ends up with more of a voice at some point in the future?
Well, I mean, they already are exerting influence on German politics. I mean, all of the parties, even the Greens and the Social Democrats, have kind of moved to the right when it comes to migration issues, which, of course, is the AfD's biggest reason for their popularity. So they already are exerting influence, and that's only with about 20% of the vote. In the future, this is something that I've thought long and hard about, to be honest. I remember hearing a quote secondhand from some conservative politician that said, Germans keep voting center right and they keep getting governed center left. And I think that shows that there is some frustration on the part of kind of mainstream conservatives that they always seem to be allied with a more leftist party to be able to govern. I think it's possible, if not inevitable, that there's going to come a point where the CDU-CSU says we can only govern in a conservative manner if we govern with the AfD. That's not going to happen this time around, even though Friedrich Merz, the leader of the CDU, used AfD votes to get a very controversial and a very kind of restrictive migration bill passed. But I can't help but think that in 4 years, maybe in 8 years, they're going to make their peace with the AfD so they can have actual conservative governance.
OK, that's interesting. And thinking more about the short term then, Eric, the polling does suggest that the CDU does best, of course, short of an outright majority, and therefore we get a coalition as is usual in Germany. But this CDU-CSU will be very unlike, will it, Angela Merkel and the policies she led? I mean, maybe the quote you were giving us earlier was very much about her leadership. Will this be a CDU that is more right than what we've known before?
Oh, yeah, most certainly. I mean, you can see in their electoral program that they've really moved to the right on a lot of different issues, especially when it comes to migration and integration issues. There's some social conservatism in there as well. For instance, they're unhappy with some of the liberalization that's taken place with kind of like citizenship laws under the old traffic light coalition, as it's called in Germany. So yes, you can already see evidence that they've moved to the right. The issue, of course, is that if they go into a coalition with one of the center-left parties, either the SPD and or the Greens, then they will not be able to implement everything that they want to do.
Well, yeah, do you think the Greens are going to pay a price with their base for all the coalition promises that they've been making, given how much they've had to water down their climate policies? Do you think they've actually blown it?
No, I don't think so, because if you look at their polling average, they're about where they were back in the 2021 election, which was their best outcome ever. So it's actually kind of interesting, and we're going to do lots of research after the election to figure this out, why their support hasn't collapsed. Although they are less popular amongst young people, and they did very well with young people the last time around, but they're going to come in at probably 14, maybe even 15%. So I don't think they've paid a price at all. The other thing, too, is every electoral cycle has different kind of concerns and different issues. For a long time before the 2021 election, it was the climate and environmentalism that was at the top of people's minds. And that just isn't right now in Germany. So, yeah, sure, they've watered down some of their more ambitious kind of policies, but that's really in accordance with where German public opinion is right now.
Eric, thank you very much. Thanks for joining us. Eric Langenbacher, the teaching professor in German politics at Georgetown University. We'll bring you plenty of news analysis and market moves in relation to the German election, building up towards those, of course, on Sunday. And we'll have a special programme on Sunday. That will be when the polls close. That's live from Berlin.
Well, coming up on this programme, we're going to take a look at Renault ahead of the Open after reports that a group representing Nissan is seeking investment from Tesla. More on the potential read-through to Renault next. This is Bloomberg.
Welcome back to the opening trade. We have 10 minutes or so until the start of trading here in Europe, and European equity market futures point just a touch higher. Let's get a global perspective, though. We're joined by our Markets Live executive editor, Mark Cudmore, who can talk about these markets in 3 minutes with us, of course. Mark, let's start with China, because we're getting nothing but positive vibes, it seems, coming through from the Chinese equity markets overnight. Alibaba certainly at the forefront, the CEO saying the pursuit of artificial intelligence is now artificial general intelligence is now their primary objective. This seems to be the kind of thing that really boosts Chinese stocks right now, the tech theme. Does it endure?
On a longer-term basis, absolutely. You know, Anna, that I think Hong Kong stocks in particular, more so than mainland stocks, is probably the most obvious stock market for 2025. It was deeply discounted, and the macro story is extremely good, and it's being helped all the time by what's happening both from the US administration, but also in terms of the AI, the narrative changing on AI. However, in the very short term, this is getting pretty frothy, and I would say that, you know, at some point maybe next week, we maybe see some sort of consolidation at some point. It's not going to go in a straight line forever. We've seen incredible gains recently. But overall, this is a market which is just getting to be slightly discounted from deeply discounted. And therefore, it is not an expensive stock market, unlike, for example, US stocks, which remain extremely expensive.
Mark, if we could say in Asia, we've had the yen swinging around the 150 mark off the BOJ bets, but also these comments from Governor Ueda. Does the slide last?
I am bearish the dollar for 2025, as you know, Lizzie, and therefore I think dollar yen does go down. I am someone who is always structurally a little bit cynical about sustained yen appreciation, but it is one of the preferred macro avenues for playing it. So even though I'm a little bit cynical that yen strength can sustain on its own, I actually think that dollar yen is going to be one of the best ways to express dollar weakness over the coming weeks, just because the macro market is dying to play the short dollar yen trade. And even though Ueda keeps on kind of contradicting himself in the guidance, I don't think that really matters the margin. What matters here is people see the BOJ as ultimately normalizing, while the narrative on the dollar is changing, and therefore dollar yen has plenty of downside in the short term.
Yeah, interesting post from one of our colleagues on the Markets Live blog then, that you run, of course, Mark, just this morning on that very subject, saying that the way that the other currencies are responding to what we've seen in dollar yen, the pop higher in dollar yen, suggests that FX traders are sticking with their views that more dollar weakness lies ahead. Do you see the market then coming round increasingly to that view?
They're starting to at the margin, but I mean, I think that's just very much short-term traders, and the short-term price action, we've seen a bit of that. The narrative of the past week or so is that while dollar has been retreating, everyone has been kept on highlighting the next chance for dollar to bounce again. Some of those reasons have been quite valid, but I'm a little bit worried about how consensus they are. The most immediate one is everyone is pointing to the German election this weekend and how that's likely to derail the euro-dollar bounce. And I actually think that euro-dollar is asymmetrically set up to reach higher levels. I asked someone yesterday, you know, when dollar is at 104.30, whether euro-dollar would reach 106 first or 103 first, and they laughed. 106th. They thought it was outrageous, and therefore I think we continue to have topside because it's the bit that no one in the market really wants.
Let's see how outrageous it is on Monday. Bloomberg Market Live executive editor Mark Cudmore, we thank you. And remember, you can get up-to-date analysis and insight from Mark and the rest of the team by going to MLIV Go on your terminal. Now let's get to your stocks to watch with Joe Easton from our equities team and some earnings, Joe, to be looking at.
Morning, Lizzy. Absolutely. So stand chart, actually the earnings looking pretty strong and a decent buyback as well. However, the stock did decline in Asia. Now, some analysts are pointing to a write-down in one of their software assets, according to a note that was read in the Citi report earlier today. So the stock actually a bit weaker, but has recovered since and trading up by around 1%. That $1.5 billion buyback potentially boosting that. Then we've got the outperformance of the stock recently on the screen here, so potentially expectations were actually pretty high coming into that, but it does look like it's recovered in latest trading for that one. Then in terms of the car makers, we're looking at Renault following a jump in Nissan on this report that a group of investors is going to be tapping Tesla for an investment in Nissan. Now, we saw Nissan stock as we got on the screen there, that was up around 9.5%. Bear in mind, Renault owns more than 30% of Nissan. It's another stock, though, that has been outperforming recently compared to the broader stocks autos index. So potentially some positivity already priced in on that one. Then in terms of Air Liquide, the big French industrial gas and chemicals company, massive firm, around 100 billion market cap, looks pretty strong on the orders. There was a bit of weakness in that stock towards the back end of last year related to some weaker margins, but the margins have come back up pretty significantly this time around for that one. So potentially we are seeing some calls higher on Air Liquide today. Then in terms of analyst ratings, Airbus cut to hold after a couple of years at buy over at Jefferies. Bank of Ireland is an outperform over at RBC, and Repsol in energy in Spain downgraded at Morgan Stanley today.
Thank you very much, Joe. Our equities reporter, Joe Easton. Be aware in the media space as well, there's a report in a Italian newspaper about some possible bid interest in a German media player, ProSiebenSat.1. So we'll certainly keep an eye on that one with German politics in mind. Coming up on this programme, then, we'll bring you the opening trade. Futures have been a little bit higher this morning. We'll see if that comes to pass. This is Bloomberg. Welcome back to the opening trade. A few minutes to go then until we get that opening trade for this Friday morning. So let's have a look at the handover from the US yesterday and what that tells us, if anything, of use about where today's Friday session goes. So this in white is the European session of yesterday, losing a little bit of momentum into the start of US trade. US trade actually started to gain momentum, but the early part of the trade was weighed down by corporate reporting out of the likes of Walmart, which weighed on expectations. If a giant like Walmart is struggling, does that give us something else to worry about? Not so, says Andrea Felsted of Bloomberg Opinion, but more on that later. So that's the picture from US stocks. And in terms of whether that gives us any handover, we do see a little bit of upside in our expectations in the futures picture for European stocks. At least if you look at the Euro Stoxx 50 futures, I mean, it's pretty flat right now, isn't it? And DAX futures, in fact, pretty flat. So we had seen earlier on a little bit of positivity, but that seems to be short-lived. FTSE futures flat as well. So we're looking pretty flat across these European equity markets, Lizzie. This Friday, looking for some direction. We have a lot of PMI data still to come, as well as a little bit of corporate earnings to factor in and a whole lot of geopolitics.
Yeah, and of course we've already had the retail sales numbers out of the UK, so if I can pick up on the retail theme but take it here to Britain, keeping an eye on the likes of Sainsbury's, Dunelm, Frasers, Currys, DFS, Kingfisher. After this big beat on retail sales, the largest increase since May, 1.7% compared to an estimate of 0.5%. Also minding stand chart, given we had those seemingly positive earnings, but actually it's down in Asia. And Renault, after we had this jump in Nissan, looking like investors are going to tap Tesla investment, and Renault owning 30% of Nissan, of course. But now we're heading towards the open, Anna.
Yeah, absolutely. So going towards the open might be a slightly slower start. In fact, we've had a few slow starts, haven't we? We get a slow start when there's nothing to trade on, and we get a slow start when there's too much to trade on. That was certainly, the latter of those was certainly the case in earlier days this week. The FTSE, the CAC and the DAX took some time to open as a result of just a lot of news flow being processed by everyone, and no doubt a lot of trades going through. Today we've got a swifter start then. The FTSE 100 is pretty flat, though. The IBEX over in Spain down by 0.1%, waiting for the CAC to open, waiting for the DAX to open. A little bit of corporate reporting, the likes of Air Liquide, for example. We'll certainly keep an eye on the UK retailers that you flagged, Lizzie. The CAC 40 is actually up by 0.2%, so we've got a bit of a mixed picture, slight upward bias to what we're seeing across European equity markets, picking up a little on what we saw in the US yesterday, maybe the latter days intraday recovery on US stocks. Perhaps then, Lizzy, just feeding in a little bit. Still waiting for the DAX to open, but I wonder what you see in the sector picture.
Well, if we break it down, we've got about 3/4 of sectors in positive territory. So chemicals leading the gains this morning, up 1.3%. Construction and manufacturing just behind, up 0.4%. And travel and leisure just behind that, about the same. But bottom of the basket, we have media, energy, utilities, all in the red this morning. Now, I did mention that we should be keeping an eye on retail, some of those names in the UK after the data there. We have Currys up 2.4%. Kingfisher in the green as well, but Dunelm in the negative, as is Freighters Group. So a mixed read of these, that beat on retail sales numbers this morning when it comes to retail.
Yeah, absolutely. The one sector that jumps out to me is the chemical sector, moving really much higher this morning. And I said we didn't have much corporate reporting, but we did have at least one. Air Liquide reported numbers, and that stock is up by 3%, in fact, this morning. The company giving their numbers to the market, full-year recurring operating income coming in pretty much in line with expectations, but something about what they've said this morning has lifted the stock. In terms of the wider picture for European equity markets and some of the movers in focus, then we have to the upside Standard Chartered. So that's one of the stocks that goes higher this morning and helps to contribute some upside to markets. So better than expected numbers coming through there, and also a buyback for investors, so perhaps that going down well.
Yeah, interesting, given that you had the drop in Asia trading for Standard Chart, but actually European traders reading it positively. Relics shares not doing so well either. They are at the bottom of the basket when it comes to media, which, as I say, is the worst performing sector this morning. So Relic shares down 0.7%.
Yeah, and interesting to see Process gaining, up by 2.3%. We talked about China, the positivity coming through there. Lizzy, we talked about the Alibaba story and the way that's lifted Chinese tech stocks. Well, Process, big owner of Tencent, of course, and so whenever Tencent goes higher, we often see that Process does the same. Let's get into a wider conversation then about European stocks. Kieran Nandra joins us, Head of Equities at Jupiter Asset Management, around the desk with us this Friday. Kieran, nice to have you with us. Thank you for coming in. So 21st of February, and we have European stocks. You know, they're trying to put in a good show this morning, up by 0.2%, but a bit of a struggle. It's been a good start to the year for European stocks up to this week. It's been a bit more of a struggle this week. Asian stocks have also had a good start to the year, and they're continuing to do so. I wonder, when you look around the world, when you look at equity markets around the world, where are you looking to for the best gains now?
So I still think that despite what Europe has done year to date, there's still a lot more that Europe has to offer in terms of just that kind of that market appreciation. So maybe just taking a step back, what we've seen with valuations, historically Europe and the US have traded at pretty similar PEG valuations. But where that valuation discount has really opened up has been within Europe. Now, some of that has been linked into US exceptionalism. And I think what we're really seeing now is just a broadening out of the opportunity set. And investors just looking to perhaps diversify a bit more away from that kind of high levels of market concentration and just trying to get a bit of more of an exposure to other growth pockets, which I think Europe is still very much offering.
OK, so those are some of the sort of top-down thoughts, perhaps. But actually, I think you tackle these things bottom-up, don't you?
Yes.
So what are the key themes that you're looking at? If you are tempted by European stocks at this point, maybe the valuations are compelling, what are the key areas, key focus areas for you?
Yeah. So historically, if you think about where you've found value in Europe, it's been much more in those kind of quality growth types of names. And I think as we're kind of seeing that broadening out of sectors and styles, I think financials are still an area that we find particularly interesting. Some of that is just due to perhaps a kind of a more normalised interest rate environment, which typically is really good for European financials. And in fact, when we're looking at earnings, just anecdotally, what's been released so far, it's been quite surprising how financials have actually managed to, I would say, surprise on the upside. That's not just driven by the top lines, but it's also been driven by perhaps better earnings quality, better loan loss provisions as well, which has been pretty positive. I think another sector that we're thinking is actually quite interesting at the moment is just on the cyclical side as well. So especially kind of cyclical chemicals. We think that energy prices might be coming down, so that's also one area that's been of interest. And then really finally, I would say things like data centres as well.
Okay.
Well, just as we've been speaking, the DAX has opened. It's flat to the upside, so barely anything happening over in Germany. But if I can ask you, Kieran, about the German election, where do you think it's going to leave German equities? Yeah.
I think so. That's a great question. So generally, Europe and globally, we've had so many elections, and that's led to a level of uncertainty, which hasn't been particularly helpful. So I think almost regardless of what the outcome is, I think just having a level of certainty is going to be very positive for markets generally. I think that's just having that. Where we've seen that on the back of most elections, it's just been that certainty premium, just because the level of uncertainty at the moment is really, really high.
I mean, that's a theme that keeps coming up when, in the context of tariffs. You know, is it more the tariff uncertainty or the tariffs themselves that are the issue for equities?
That's a great, yeah. So on our side, we see it as just being that tariff uncertainty, because there is so much. Is it the bark? Is it the bite? Which is problematic, and we saw just recently when we came to kind of Mexico, for example, one thing was announced and then very quickly it was just kind of either kind of rolled back or kind of adjusted, I would say. So again, when we're looking at when we're having conversations with companies, the types of companies that we're looking to invest in are those that maybe have the nimbleness and the ability just to kind of move production sites from one country to another. And I think that, again, it's that uncertainty, just having those companies that can adjust to that environment.
So agility and an ability to adapt is important then, Kieran. I mean, that takes us to the Trump White House, President Trump and his White House agenda. And I wonder, we're hearing some talk of some pretty big suggestions, an appetite for risk perhaps from the White House that maybe we haven't seen for some time. So some in the markets are talking about whether we might see a new Mar-a-Lago Accord, which would be like a Plaza Accord, devaluing the dollar. And I just wonder, in terms of the risks that you think about and things that are out there, do you stress test your portfolios to some really pretty extreme outcomes? Do you have to increasingly do that as politicians of a populist backdrop seem quite comfortable with taking quite big risk?
Absolutely. So we are absolutely flexing all of our portfolios just to look at those very extreme scenarios, and bearing in mind that we absolutely are able to flex portfolios, and so you see where we're overweight and underweights in terms of our factor exposures. That's a really clear way where we're able to kind of really isolate what the impact might be. But I think it's also really important to bear in mind that some of those second-order impacts are also something that it's actually quite difficult to model for. So that comes back to that original point, which is, why the nimbleness is really important that we're looking for when we're looking to invest in companies.
Well, when you contrast that pro-business offering of Donald Trump, the pro-growth offering, with the pro-growth offering of the UK, and then when you hear the likes of Glencore's CEO talking about considering moving away from their London listing, I wonder if you think that kind of trend is going to continue, this shift away from London?
So if you talk to a number of companies, what we're really focused on is just the pipeline for listings in the UK, and that pipeline is actually increasing. Okay. So the reasons for perhaps that lack of interest that has been in London stock markets has really been long-term structural decline of pension funds not investing as much in the UK equities. And I think what's really important to remember today is that we've got much more of a kind of pro-growth and pro-change agenda from politicians that perhaps wasn't the case before. I think that's a big difference. And I think what we really just need to do is remember that the UK remains an incredibly attractive place for companies to invest. It's just trying to stem that liquidity drain that we're seeing. And I think once we're able to stem that, I think that'll be a game changer.
And you see more listings then coming to the London market, Kieran?
So the pipeline that we're hearing about is much better than it was this time last year. So I think a lot of the reforms that have been spoken about, which maybe haven't been implemented because of that lack of political stability, that's now changing. So we're hearing a lot less that companies are finding it difficult to cope with the listing rules. So I think that's the kind of a topic that was very much in the rearview mirror. And I think now what's really important is that we get an injection of some of those the growth impetus and just having flows coming back into the market.
They're not all banks and energy companies or oil companies.
No, exactly. No, that's very true. So I think AIM is clearly very, very important.
Yeah.
But specifically when you're talking to those companies, what is it that they want from the Chancellor to persuade them to list here?
I think the listing rules have actually improved. I think what we need to see is just more of that flow coming back into the market. So we've had a couple of topics that have come up, which I think are very important, which is things like stamp duty, on share transactions. It's even trying to maybe shift the agenda from ISAs, from cash ISAs, into more stocks and shares. I think those are the kind of the things that we'd like to see more on.
You mentioned a few things that you were investing around, Kieran, earlier. One of them was cyclicals, and one of them was data centres. The energy transition, then, where do you see the best opportunities for that? Because there are different parts of the supply chain that you can pick to get exposure.
Yeah. So I think still very much what we call like the picks and shovels is going to continue to be important. And despite what's happened with with NZAM, I think that is still very much a capex trend that we see continuing, maybe to a lesser extent than before, but we still see that kind of evolving. And then when it comes to that's obviously the energy transition that kind of taps into in capex, just in terms of old infrastructure as well. But even what we're seeing with AI, I think that those second-order impacts will be something that we still continue to be interested in.
Yeah, some of those capex trends really worth watching then, and productivity. Thank you very much, Kieran. Thanks for coming in. Kieran Nandra, Head of Equities at Jupiter Asset Management. And that thought about data centres takes us nicely into at least one of our core six. Let's have a look. Schneider Electric trading higher by 1%. Makes me think of that when I think about data centres. We've got Ferrari actually on the back foot, but elsewhere, European equity markets then, at least as far as the core six are concerned, holding their heads above water pretty strongly. Stock 600 more broadly is up by just 0.3%. Let's get to Joe Easton. He's got some individual stocks on the move. Joe.
So one of the top performers this morning, Anna, is Stanchart. We're up 5% at the moment for Stanchart in London. Now, bear in mind, this stock was significantly lower when I got to my desk this morning, and I've had to figure out why this has actually reversed that move in the London trading. It does look like that buyback is making up for a bit of disappointment on the write-downs in one of their software assets. That's what analysts are saying today, so a really good jump. And the CEO's got a 46% pay rise, so everyone's going home happy from that one today. Then in terms of Air Liquide, big debate is whether that's a qua or a ca. We're going to go with a ca rather than Air Liquide. Now that one is up 3.6%. The order's better than expected, and the margin's actually rising by a full percentage point for the company. It's industrial chemicals and gases, and that's lifting the chemical sector today, really doing all the lifting in that sector on its own for the French company. Then we've got building materials. Kingspan out in Ireland getting its biggest gain in around 18 months. It's up 10%. That was around the third best performer on the Stock 600 in the opening of trading. EBITDA much better than expected. It's a supply of materials used in the building sector, building walls, that kind of thing. So it's getting a good boost today. Then in terms of Alton, this one was actually another one that's been keeping us busy because it was called lower and it's now up 14%. This is a software company. It's in the aerospace sector mostly. They supply into that business. We're up 14% following earnings, a big jump, a reversal. Some of those early calls we got from the market makers early this morning. The biggest gain in 13 years, according to our headlines there. Then on your broker moves, Airbus is downgraded. Jefferies had been a buyer of that stock for 2 years. Did get those weak results out of the company yesterday and disappointment on the dividend. That's what Airbus was. The one that Jeffrey said that about yesterday, to get my wording right there. So we're coming down a bit on that one. And then finally, Repsol, another one that has a downgrade today. This is over at UBS. They say the positivity is priced in at the Spanish energy company. Again, it's post-results. Analysts updating their ratings. Repsol down 1% in Madrid this morning.
OK, Joe Easton from our equities team, we thank you. You did mention some of those UK retail names, and they are mostly in the green now off the back of that retail sales number earlier that we saw. And actually, that increase driven by food stores, the biggest rise since March 2020. We also got the GfK consumer numbers out earlier today. And actually, that's firmly still in negative territory, even though all the metrics within the report have improved for February. But we're also going to get some data out of France in just a few moments. The latest PMI numbers, the expectation for a tiny bit of improvement across the board, though still in contraction territory. And indeed, we are seeing on manufacturing an increase from 45 to a reading of 45.5. That a beat. On services, 48.2 is where we were previously in February, 44.5, so a fall there way below the estimate of 48.9, and the composite reading also a miss, Anna.
And look at that euro drop. Woo. So the euro drops on the French PMI data, down by 0.3%. That services number really coming in weaker than expected. We are going to go get the German number, aren't we? Which, with the German election looming, of course, is very worth thinking about. So we're going to get that in around 15 minutes' time. But really underwhelming services numbers, aren't they? And this is an economy that's had, well, a political backdrop we talked about many times, had a lot of uncertainty to it, had a bit more certainty of late, but still the services side struggles there. Yeah,
the lowest since 2023 on that services number. And so, as you say, a real reaction when it comes to euro-dollar, down 0.25% at a 104 handle. You can see it there.
Yeah, absolutely. So that's the weakness in France. We will certainly focus in on these PMI data as it comes out from Germany. That's in around 15 minutes' time. Coming up, shares of Standard Chartered soaring after reporting plans to hand back $1.5 billion more to shareholders. We'll bring you highlights from my conversation with the CFO next. This is Bloomberg.
Welcome back to the opening trade. We're nearly 20 minutes into today's session, and we do have your stock 600 up 0.2%. The DAX just slightly to the downside. But really, if we look to the bond story, we just had the French PMI data dropping, and a big surprise when it came to the services number. A miss there, and that really changing the outlook for the ECB's rate bets. So now traders have added to those bets. They see 80 basis points more easing this year. And you've seen bunts extending their gain off the back of these numbers as well. The 10-year yield lower 4 basis points at 2.49%. Oat yields on the 10-year lower 3 basis points at 3.2% as well. So we keep an eye on that, as well as the euro drop. 104 is where we trade at the moment. But just getting back to the equities story, interesting to see as well this disparity when it comes to Standard Chartered earnings and the reaction in the UK European session, 4.7% of a gain compared to what we saw in the Asian session, Anna. Traders not so impressed.
Right, yes, absolutely. So the share price is going higher here in Europe, and it does seem as if some are citing the buyback as being one of the reasons for that. Let's check in on Standard Chartered shares. There you see on the screen, up by 4.7%. The bank reported fourth quarter earnings that beat estimates, and they announced, of course, an additional $1.5 billion share buyback. I spoke earlier to the CFO, Diego De Giorgi.
First of all, let's remember that in terms of contribution to the top line, our net interest income contributes about 50%, and our non-net interest income contributes about another 50%. Non-net interest income has very strong engines of growth, up 20% last year, as we have just discussed. And in terms of net interest income, we have been building up our hedges, de-risking the delivery of net interest income, and I think that positions us well for this slightly more uncertain world.
OK, so let's turn to the other part of that, of the income stream, and away from net interest margin and the other areas. One of the areas I want to ask you about is global markets and what you've managed to achieve there in the global markets business, getting a boost from some of the volatility in markets, it seems, traders doing well on that. And that's been a story across Wall Street, across lots of the banking sector. Thing is that sustainable in any way? Do you have any visibility on whether that kind of performance is sustainable?
So I think it's sustainable for us. And the reason is that our markets business, as we often like to point out, is a peculiar type of market business. Because we are a giant connector bank, really 75% of what we do in markets is helping our clients manage their exposures to foreign currency, interest rates, and other risks. That is very recurrent activity. When volatility then spikes, we add to it performance in helping them take advantage of those market dislocations. But the delivery of our financial markets numbers is highly de-risked once again by this attractive complexion of the business, and it's business that, by the way, grows well. We pointed out at Q3 at our last set of results that this part of the business grows at almost 10% per annum, and it's been doing so for 5 years.
Let's get analysis from Bloomberg's Jenny Serrain joins us now. And Jenny, he was putting the focus on some of those fee-generating businesses rather than the net interest margin-reliant ones. And one of those areas is the markets business. He talked about that. A really big growth there, 46% higher in the quarter. I was talking about volatility in markets driving that. Is that the whole story there? What's happening?
So Standard Chartered is an interesting bank on this front because really it is trading, but it's actually trading for corporate clients rather than the traditional Wall Street clients like hedge funds or asset managers that we would think of. And these are clients that, the French PMI data that you guys were just talking about, these are clients that pay intense attention to that, because that is really what's at play in their Treasury books. And so Standard Chartered is in there with them, kind of helping them position around these big swings. And that's why I think they're kind of, through good and bad, able to see a really strong generation of revenue from this business, because it's not as volatile as maybe hedge funds putting on and putting off positions, or asset managers kind of shifting big ways in and out of equities. And so, yeah, I think it's interesting. It's a real strong generator of revenue for them, and then helps in the times where you might be looking out to lower interest rates to come.
The other thing that Diego said to Anna is that there's more to do still on the stock price. I mean, what are UK investors in general, actually looking for from the UK banks?
Yeah, I think it's really interesting. Standard Chartered is our last big UK bank, and something we heard kind of consistently throughout this earnings season was that the Labour government really just is kind of in need of giving some assurances on the regulatory front. So you've heard so much from that. I think in the interview this morning, Diego was talking about the bonus cap getting removed, and how that was a really big win for them, and something that was really important to being able to keep talent, which obviously then translates to better performance from the bank. So I think that's the big thing for investors right now, is kind of getting an understanding of the regulatory environment, and probably kind of one of the last remaining questions that they have about.
Jenny, thank you very much. Bloomberg's Jenny Serrain on Standard Chartered. That stock price going higher on the buyback this morning. Coming up on the programme, we turn our attention to Germany. We will break down the latest PMI data and ask author John Kampfner how the election has shaped the political and policy debate. But first, the far right has loomed large over the election campaign. Oliver Crook reports.
Political parties have successfully blocked the far right from power ever since the end of the Second World War. But ahead of the election, how strong is Germany's so-called firewall? In January, conservative favorite for the Chancellery, Friedrich Merz, attempted a hardline overhaul of migration policy. And the motion received backing from the Alternative for Deutschland, breaking with that political tradition and sparking protests across the country. The anti-Euro and anti-immigration AfD first won seats in the national parliament back in 2017, a rebuke to Merkel's open-door refugee policy. 7 years later, as immigration climbed the list of concerns and economic stagnation set in, the AfD would win its first ever state election.
Germany is not in a very good state. We have the highest energy prices worldwide. We are in the middle of a migration crisis.
AfD leader Alice Weidel is running on a policy of mass deportation. It's a message that's also found favor across the Atlantic.
No voter on this continent went to the ballot box to open the floodgates to millions of unvetted immigrants.
While the AfD support for Merz's border bill did little to hurt him in the polls, he'll need at least one coalition partner for a majority.
We will not take these right-wing populists into a government which is led by me. Never.
But no matter what mainstream politicians say, the far right has shifted the political debate in Germany. And as for Weidel, she was all too ready to declare that the firewall had fallen. Oliver Crook, Bloomberg, Berlin.
This is the opening trade. We're 30 minutes into today's session. We've already had the French PMI numbers, euro down, bonds up off the back of that services surprise. And we now have the German numbers as well. So German services PMI coming in bang, well, just a little shy of the estimate. So 52.2, the estimate was for 52.5. Manufacturing 46.1, so a beat actually out of Germany on manufacturing. The estimate was for 45.5, and the composite coming in at 51. The estimate was for 50.8. So this is interesting ahead of the German election, Anna, of course, a snapshot into the economy there.
Yes, and there was a temptation to pair losses on the euro as a result of that data as it dropped, because, yeah, the services story not as bleak as in France. It's well above 50, so it's in expansion territory on services. But then a reminder on the manufacturing side that we're still in contraction territory on German manufacturing, and that number, yes, it's better than expected, but it is still with a 40 handle, 46.1 as you describe. And so the euro did try and push a little higher, but didn't get very far, did it? 104.77 as the market asks questions about, OK, so how many rate cuts are we going to get this year from the ECB?
Well, just on the French number, I saw a note from Tariq Kamal Chowdhury over at Hamburg Commercial Bank saying this is a recession with no end in sight. So a much bleaker picture out of France than Germany.
Well, that's a gloomy backdrop to go to the polls with, isn't it? Let's put that PMI data into context ahead of the German election on Sunday. Bloomberg's Oliver Crook joins us now from the Chancellery in Berlin. Ollie, that PMI reading then, slightly better than expected, but still below 50 on manufacturing. The services data, at least, coming in and not freaking the markets out quite like the French data did. How is this growth story, or lack of it, though, playing into the election?
Yeah, I mean, I think it's the fundamental mood music, Anna, as you were just mentioning, to basically the last few years, the post sort of pandemic times and the post-invasion of Ukraine by Russia and the energy crisis that ensued for Germany. And that's really been the story here for Germany economically. I mean, we've talked about the sort of years of contraction in manufacturing PMI. I mean, listen, 46.1 is a beat. It is, though, still firmly deeply in contraction territory for German manufacturing PMI. The last time you got a positive print on German manufacturing PMI, you've got to reach back to June of 2022. So that is for how long we've been talking about sort of severe contraction within the sort of German manufacturing space. And that was fine on paper for a while, but it's really last year that we started to have the rubber hit the road and what that meant for job cuts. We know about Volkswagen, the long negotiations that have been going on with the unions and the tens of thousands of jobs and sort of salary reductions that are going to be going on there. We got it out of yesterday out of Mercedes-Benz. You know, even the sort of luxury automakers are not spared. They're now doing a cost-cutting plan across the business. 10% across the business is really sort of the headline there. So this is sort of the cycle, and we're not really, I don't think, at the bottom yet. The people that I talk to, the economists, in terms of job cuts, is we may not have seen the end of it, and that is precisely what is going on in everybody's mind heading into the sort of the booth this weekend on Sunday, where they're going to elect a new government and eventually a new chancellor who will sit in the chancellery here behind me.
Well, before they do, Ollie, how are the polls looking before we get to the election?
Yeah, Lizzy, as we've talked about a lot throughout this sort of election campaign, and again, this is a sort of process that began on November the 5th with the sort of pulling of the plug on the coalition, the collapse of the German government, the same day that Trump was elected president of the United States. And that has been sort of the long sort of drawn up, we call it a snap election. It's taken quite a while to get it going, but that is what we're leading to into the weekend. And what has been a sort of main feature of this are two things. One, the AfD, the Alternative for Deutschland, the far right, as a real protagonist in the political story in Germany, really for the first time at the federal level. This is the first time they've ever put up a chancellor candidate, and they're going to poll in the second place about 20%. But really, it's been Friedrich Merz and the CDU, Merkel's traditional party here in Germany, that has been leading with 30% of the vote. If you look back sort of historically and where Scholz came in, he only won about 25% of the vote last time, which is why he had to hobble together that three-way coalition. Heading into the vote on Sunday, I think that most market participants, at least as far as the market is concerned, what they would like to see is the small parties to get under 5%, to get knocked out of the Bundestag, have a nice strong majority where you could make either a sort of two-party coalition to really get things moving here in Germany, because a large complaint has been that while there's been sort of all of this sort of economic gloom, that there's been an impossible way to get a sort of cohesive and coherent economic policy. So something is really better than nothing. And the worst-case scenario would be, again, a sort of fractured political system where you have a very sort of ugly coalition negotiation that goes on for months and months and months while you're staring down the barrel of tariffs potentially from the United States.
OK, we wait for those ugly negotiations potentially. Bloomberg's Oliver Crook, we thank you out of Berlin. Well, let's stick with that German election theme and discuss whether it actually can bring stability back to Europe's biggest economy. We're joined now by John Kampfner, author of In Search of Berlin, the story of Europe's most important city. Good to talk to you, John. You also wrote a book called Why the Germans Do It Better, Notes from a Grown-Up Country. I wonder if you think, given all that chaos Ollie was just talking about, it still is a grown-up country.
Yes, good morning. I get asked that question all so often, 2 or 3 times a week, sort of, do I still stand by that thesis? The answer is, well, that was 5 years ago and things were looking different. I still think there are some fundamentals about the way German society is structured that may, just may, see it through these incredibly turbulent times. All the tendencies that you have been setting out in your introductory packages and in Ollie's two-way just then are consistent with everything that is going on pretty much everywhere else in the Western world, where you have populist parties either running things, in the case of the United States, with spectacular extremism, or in Europe, or they're knocking on the door. So there's nothing particularly German about what is going on here. People look at Germany in a different way because of its war history. But this is, in all respects, an absolutely crucial time here for this country. Not only the domestic political agenda, you've been talking about the economic downturn, 2 years of recession this year, heading that way as well. The migration issue consistently being number one or number two on people's agendas and being very, very heated. But also the spectre of Donald Trump looms over everything here in Germany. His new love-in with Vladimir Putin is really freaking people out. Germans had 3 years ago been told by the outgoing Chancellor, Olaf Scholz, to prepare for a more muscular defense policy in defense of Ukraine. And now they're being told by what Germany has always believed to be its best friend and partner, the United States, that actually Putin is the person we should be dealing with and Zelensky is a dictator. So it's just incredibly confused here and upsetting for so many people.
Yeah, I mean, of course, it's not unique to Germany, but the tone, surely you would agree, is nowhere near as polite as previous German elections. Do you think that this coalition chaos is the new normal in Germany?
So on the language, absolutely. It has been quite startling to watch the way the old coalition collapsed in acrimony and pretty much also the narcissism of small difference. This was about pretty mediocre egos fighting it out over not very much. And as a result, the government collapsed. If that doesn't undermine people's confidence in the political process, I don't know what does. The election campaign, the debates have been pretty heated as well. I personally don't mind that. I think fiery politics, particularly if it's on issues rather than individuals, is a good thing. What this country needs most of all, as Oliver was talking about when looking at the opinion polls, is strong leadership. Now, Olaf Scholz was, in this regard, absolutely abject. He showed no leadership at all. Germany stuttered for 4 years. I personally don't think the fact of there being 3 parties in government, it surely doesn't help. But I didn't see that as being the reason things were went so badly wrong. I saw a failure of leadership in Scholz, who didn't just simply say, we're going this way, guys, are you going to collapse my government or not? And I think Merz is going to do that.
John, can I ask you about the rise of the AfD? Clearly a big theme. It has been in regional politics in Germany and now increasingly on the federal stage. We've seen the CDU, CSU flirt with some kind of vote borrowing from the AfD in at least one area of policy. We spoke to a professor earlier in the programme who said, look, the firewall is going to stay for now, but it will go eventually. I know you've looked at Austria and the example set there as well. Do you think, to what degree do you think a CDU, CSU-led government will cooperate in some way with the AfD?
The firewall is still there, but it is incredibly fragile. Friedrich Merz continues to say that he wasn't looking for AfD votes. He was simply trying to put down a marker to say we need much tougher migration legislation. I beg the mainstream parties to join me. If they don't, then it's out of my hands. Most people think that was pretty disingenuous. I think he was struck by the extent of the pushback he received, demonstrations outside his party offices. It absolutely shook Germany to the core. That sense of bewilderment was as nothing compared to J.D. Vance's speech a few weeks later at the Munich Security Conference, attacking German democracy and very publicly embracing the AfD, something that Elon Musk had already done. And as a result of all of this, I think a more chastened, a more sober, at least I hope, Merz has emerged from this, in which he won't flirt with the AfD, but he's also saying to the Social Democrats and the Greens, and it could be both parties he has to go into coalition with, look, you guys, don't sit on the fence, don't make me problems, join this government, toughen up a bit, and come with me on this journey, because the alternative, either now or in 5 years' time, could be the AfD.
John, I wonder what you make of Elon Musk and J.D. Vance getting involved in German politics. And I'm trying to cast this forward because we can all see the impact it has had and the headlines it created in Munich, as you say, and when Musk addressed the AfD conference. We can see that in the rearview mirror. But looking ahead, we could be going into a protracted period of coalition negotiation, do you think, maybe? And should we expect US voices to be quite loud in that?
I'm sure we will, given the amount of things that Trump, Musk and the others say on a daily basis about so many things. I'm pretty sure we're going to hear some aggressive, disparaging remarks about Germany. I hope very much, and Merz has asked the other party leaders to form not just a robust coalition, but to form it quickly. In 2021, it took 3 months. The process was ridiculous. And in that time, that was before Putin had invaded Ukraine, things were a little bit, or a fair amount, calmer. There is no calm here. There is an absolute sense of being on the brink here. So the impulse to cut a deal, to form a government quickly, will be strong. Now, all of this, by the way, is predicated on our assumption that the opinion polls are accurate. And German pollsters do have a pretty good track record of calling it right, plus or minus 2 points, which is the usual margin of error. And what is really weird is that since Scholz collapsed his own government in November, the polls have barely moved on for anybody, up or down a little bit. Given the extraordinary events within the country, terror attacks, fights in parliament, and then the first month of the Trump government, it seems really quite bewildering that the polls haven't moved at all.
John, you talked about how things could look very different for the AfD in a few years' time. I wonder, just drawing on your British perspective, is the SPD in terminal decline, or do you think that it could stage a turnaround in the way that the UK Labour Party did post the 2019 election defeat?
Well, actually, I would turn it around once more and say that if the Keir Starmer government in the UK, which has been stumbling along, really, since it won a huge majority in July last year, and pretty much had a tailwind and could have got on with a pretty active agenda, and has stumbled at every step of the way. Its poll ratings are extremely low. A recent poll put the far-right Reform Party in just ahead of the Conservatives and Labour, a historic poll that. So I think you have a possibility that Britain and Germany copying each other in the other regard, in the regard of the far right, same as in France with Marine Le Pen's RN. And you have the possibility, all of them, aided and abetted both by Vladimir Putin and by Donald Trump. You have a pretty spectacular challenge now on mainstream parties of the conservative Christian democracy school and of the Labour Social Democratic school and the Liberals in between.
John, thank you very much for joining us. Good to get your perspective on Germany and beyond. John Kampfner, author of In Search of Berlin. We will bring you all the news, analysis and market moves as we continue to build up to the German election, including, of course, a special programme when polls close. That's on Sunday. That broadcast live from Berlin. Coming up, the US Treasury Secretary doubles down on Donald Trump's criticism of the Ukrainian president. We'll have more from Scott Bessent's interview with Bloomberg Surveillance next. This is Bloomberg.
Happy Friday, everyone. 8:48 a.m. in London, and I want to take you to one of our top interviews now. Speaking on Bloomberg Surveillance, the US Treasury Secretary, Scott Bessent, has doubled down on US criticism of the Ukrainian President, Volodymyr Zelensky.
I think President Zelensky, unfortunately, escalated and has put some daylight between...
How did he escalate?
A lot of his remarks in Munich I thought were inappropriate. President Zelensky, when I met with him, assured me that he'd be signing the minerals deal in Munich. He has not. And look, the real purpose here, and I think it's turned into kind of this media circus, that President Trump had a very elegant plan, and it was bring the Ukrainians closer to the U.S. Let's do this economic deal. And even Karl Rove in the Wall Street Journal this morning approves of it, that the U.S. with greater economic interest in Ukraine provides a security shield. So the sequencing of what was going to happen was bring the Ukrainians closer to the U.S. Through economic ties, convince the American people and the American public, get them on side, and then tell the Russians, go to the negotiating table with a very fulsome message that if we need to, we will take sanctions up.
Well, what about tapping the Russian frozen assets, some $300 billion? Would you force your European counterparts to not just have them frozen, but actually tap them? Trump talks about repaying the American taxpayer. Shouldn't Russia be a part of that?
Well, what's happening now is they are being tapped. So the returns from
the interest,
the returns from the freezed asset pile is going to pay the Europeans. You know, what's very important to understand here is that everything the U.S. has done to date, the American people, the American taxpayer, is grants. The Europeans, roughly half of what they've done are loans, and the runoff from the frozen assets is being used to repay European loans.
Have you communicated that to the Europeans, that you're upset with them?
What's that?
Have you communicated to the Europeans that you're upset with them?
I think Vice President Vance did a pretty good job in Munich.
Do you think they understand that the United States is running a deficit of north of 6%, close to 7%, and that the budget for defence is north of $800 billion? Do you think they understand the gravity of the moment in the United States, the U.S. perspective?
Look, I think that they understand that President Trump, during his first term, this term, Vice President Vance, and the entire security apparatus have told them that many of the countries are deficient in their NATO spending, and they need to come up.
Great to see Scott Bessent back round that table without his investor hat on and now with his US Treasury Secretary hat on. An interview on Bloomberg Surveillance.
Now, let's have a linking moment between this and our next item. The South African President Cyril Ramaphosa has downplayed a rift with the US. There seem to be plenty of those to go around after the Secretary of State Marco Rubio snubbed a meeting of G20 foreign ministers taking place in Johannesburg. The US Treasury Secretary Scott Bessent has also said he won't be attending a meeting of G20 finance ministers that takes place next week. Let's get more details. Bloomberg's Jennifer Sabasaja joins us now from the event in Soweto. Jen, good morning. So what has Cyril Ramaphosa been saying?
You know, Anna, as you were just mentioning there, a lot of nations have really had quite a few weeks and a few months, including South Africa. But we've heard from President Ramaphosa. He opened up this G20 foreign ministers meeting yesterday, at least trying to not let a lot of the noise that we have been hearing overshadow his agenda going into this G20 presidency. And a lot of that has to do with addressing a lot of the concerns for the African countries and the global South, but also trying to promote multilateralism and global reform of some of these multilateral institutions. Here's part of what he said yesterday.
We continue to call for the UN Security Council, the multilateral trading system, and the international financial architecture to be realigned, to be reformed, to make them more representative, more agile, and more responsive to today's global realities.
And Anna, we've heard a lot of that sentiment echoed by many of the leaders who are here today. There's about 35 approximately foreign ministers who have been meeting between yesterday and today, trying to see if they can find some consensus on a lot of the geopolitical issues that we talk about on the show day in, day out, and see what the G20, if anything, can do to address some of them. And what we've heard from President Ramaphosa is he does not deny the fact that there is a lack of cohesion and consensus on a number number of these issues, but they're at least trying to address them. But of course, the big elephant in the room is not having the top U.S. representatives here. We do have U.S. officials, though, that are here on the ground, but there is a noticeable absence of the U.S., but still they're trying to progress with the agenda.
And Jen, what does that US snub mean for the agenda then?
Right. Lizzy, what we've heard from the president here is they're trying to say it's still business as usual from the president and from others. We should note that actually without Secretary of State Marco Rubio and Treasury Secretary Scott Bessent being here, over the past 24 hours, we have seen a number of ties between some of these member states and others forging closer relationships. Yesterday, we saw Foreign Minister Sergei Lavrov of Russia meeting with his counterpart from China. We've seen the South African foreign minister meet with his Brazilian counterpart, and we know a number of others have already started here behind me today and are continuing throughout the rest of the day. And so we're seeing a lot of existing relationships and also somewhat new relationships continue to be repaired. And I'm talking specifically about the EU and South Africa, which has been a bit fractured over the past few years about disagreements on some of the geopolitical issues we've been talking about. But we've seen the EU come to the table with South Africa, continue to pledge that their past disagreements are in the past, and hopefully they can move forward, and even pledging even more investment. And so potentially this opens the door, without the U.S., potentially this opens the door for more of those relationships to be developed, and also a number of the BRICS countries to continue to discuss some of the issues that are top of mind.
All right, Bloomberg's Jennifer Sabasaja in Johannesburg. We thank you for your coverage of that G20 foreign ministers meeting. And Africa's rocky relationship with the US under President Trump is the theme of the first episode of our new monthly show, Next Africa. That's on Friday, February the 28th.
OK, we'll certainly look out for that. In the meantime, we have the European growth story to focus on then, Lizzy, and we're looking ahead to our weekend, of course. Let's do the growth story first. Of course, the services PMI from France came in very disappointing. That dropped the euro, and the German data didn't do anything to really recoup those losses in the euro, just a little, but not much. There we go. That's the short version of the PMI story. But the weekend, dominated by fashion, apparently.
Yes, we've already had the opening shows of London Fashion Week, and we're going to go...
in attendance?
No, but, you know, it brings back memories
you should have been.
time.
Where's your invitation?
I know. Well, we look forward to the Burberry show, perhaps, on Monday, that will take us through to the end of the week. But there's lots of rugby. I bet that must be where Guy Johnson is, hey?
What, all week? Do you think he spent all week watching rugby? I think his dreams are probably made of that stuff. Apparently, the fête de citron, which was on that graphic we just had there, that marks the end of winter in France. So I'm all behind that. Right, speaking about the weekend, don't miss Bloomberg's new weekend edition. That is it for opening trade. This is Bloomberg.